Ladies and gentlemen, we'll be starting in just a couple of minutes, so don't worry, we haven't forgotten you're here, and we'll begin very, very shortly. We're just waiting for one of our guests to join us remotely. Feel free to carry on talking, by the way. You don't have to be quiet. All right, ladies and gentlemen, I think we might actually start. We will hope our remote panelist joins us, but if not, I'm sure we're going to have a fun time anyway. Hello from a sunny Samarkand, where we're holding, I'm being told to hold. We will be hopefully shortly starting. I think they're just sorting out a few of the technical issues at the moment. So. Hello and welcome from a very sunny and warm Samarkand, where we're holding our 2023 EBRD Annual Meeting and Business Forum. Welcome to all of you here in person in this room, and those, of course, joining us online. My name is Jonathan Charles. I'm a former Managing Director of Communications at the EBRD, and today we are looking ahead to what may be in store economically. We are forecasting some economic growth amidst several shocks. These are hard times for the economies in the EBRD regions and many advanced economies as well. Winter is behind us, of course, as we see in the sunshine here today, but it offers little respite for our regions. And indeed, in fact, recently the IMF has downgraded its forecast for many of our economies, and so are we. Will summer offer us some hope, some green shoots of recovery, or will we just be getting by for quite a while yet? Here to help us launch our latest regional economic prospects are our economic heavyweights, Beata Javorcik, who is the EBRD Chief Economist and Professor of Economics at the University of Oxford, and Heike Harmgaard is the Managing Director for the Southern and Eastern Mediterranean region here at the EBRD. Also joining us is Sergei Guriev, a professor from Sciences Po and Provost, former EBRD Chief Economist. We hope he'll be with us very, very shortly. But before we begin, a reminder that translation in English and Russian is available on your headphones and also on our Interactio app if you're watching online. The details you should be able to see right now if you're here in the room or online. We'll also be taking your questions towards the end of our panel. You can submit yours by going to slido.com, slido.com, and using the code 1279662. Choose the Regional Economic Prospects session, post your question there. If you're here, there's a QR code on the back of your seat to help you, or should be. Just point your phone and ask your question. And we'll also take some questions the old-fashioned way, by the way. If you want to put up your hand, we'll try and come to some questions if you're physically here in the audience. For those of you who are watching us on LinkedIn or YouTube, please feel free to post your questions in the comments, and we'll pick them up. Now, let's start with an overview of economic growth across the EBRD regions. Are we seeing a further slowdown? What is the main worry around inflation? All these issues. Beata, over to you.
What is happening in the EBRD regions should be viewed against the backdrop of developments in the world economy. And the midterm projections for the world economy are the worst they have been in 30 years. Now, the robust post-COVID recovery in the EBRD regions was interrupted by the war. And even though the growth held up in the first half of last year, the economy started slowing down in the second half. And this year, growth is going to be subdued. We expect some pickup next year. Now, Central Asia stands out. It experienced a shallower recession during the pandemic, but also a less robust recovery. But before we go region by region, let me start with Central Europe. For Central Europe and the Baltics, it's going to be a very challenging year. In that region, we are worried about elevated energy prices. They came down from their peaks, but they are still 6 times as high as in the US. Inflation, as Jonathan mentioned, is eroding the purchasing power of wages. And of course, there are spillovers from slowdown in Western Europe. Now, similar comments apply to Western Balkans and Southern and Eastern Europe, though there, Bulgaria is enjoying increased confidence associated with its expected accession to the euro, and Romania is engaging in a lot of public investment supported by the EU fund.
Okay, so it's quite an interesting picture, and we'll dig deeper in some of the other regions now. I'm glad to say we're also joined by Sergei Guriev online from Paris, former EBRD chief economist. What about the wider region around Ukraine, Russia, Central Asia? How do you see that, Sergei?
Very unusual year, last year and this year, and of course that will have impact on the years to come. It is not a good year to be an economic forecaster because there's so many dislocations. And when you actually look at the forecasts we have made a year ago and what we look at now, even if you just compare EBRD's own forecast made a year ago for 2022-2023 and look at what's happened actually in 2022 and how EBRD has revised its forecast for 2023, you see many changes. And the broad picture depends on the country you look at. So interestingly, EBRD has been right on target predicting minus 30% decline of GDP in Ukraine. On Russia, EBRD, like everybody, was too pessimistic in terms of GDP or too optimistic in terms of impact of the sanctions. Russian GDP has done better. We'll talk about that today. Other countries have seen very different impacts. If you think about a country like Armenia, it had double-digit growth because of the unprecedented exodus of qualified upper middle-class Russians. Some countries have benefited from trade diversion. So the picture is very, very heterogeneous. There are other countries where EBRD thought the impact would be muted, but that suffered a lot, for example, Moldova. So there is no one single takeaway from what's happened in terms of economic growth and in terms of forecasts of economic growth. And more importantly, unfortunately, I should say that it's very hard to see what's going to happen in the wider region overall, because we don't know how the war is going to play out. We don't know which sanctions will have which impact. We don't know whether secondary sanctions will force neighbors of Russia to change their behavior. So this is really an uncharted territory we are in. And unfortunately, what we've learned from the previous year is it's very hard to make forecasts, especially about the future.
If I could just ask you one question, Sergei, just following up on what you said and picking up on one of the points you made about why you think Russian growth in particular was stronger than you expected, because obviously that does have a ripple effect as well, for example, here in Central Asia.
That's exactly true. It's been unexpected. If you go back 1 year, especially March and April, that's when the forecasts of IMF and EBRD are made and then published in April and May. Everybody was on the page of minus 8%, minus 10% for 2022. The outcome is minus 2%, which is much, much better. And so there are several factors. I will just name a few. One is real sanctions kicked in only in December. For the whole year of 2022, Russia was enjoying high oil prices and continued to export oil and gas to Europe. The oil sanctions only started in Europe in December 2022 against Russian oil, in February 2023 against Russian oil products. The other story is, of course, a year ago we were really in the unknown because sanctions were unprecedented. Sanctions against the Russian sovereign fund and central bank were largest in history, and so there was a panic which triggered this crisis, thinking that Russia is probably going to go down the drain like the other sanctioned countries before Russia. But the difference, of course, is that Russian policymakers are much more competent in technical terms than, say, policymakers in countries like Iran, Venezuela, or for that matter, monetary policymakers in Turkey. I guess we are going to talk about Turkey as well. And finally, when people talk about GDP dynamics, we should remember that during the war, GDP dynamics is a misleading metric. When you produce artillery shells or tanks, you add to GDP directly. 1 billion worth of weapons is 1 billion worth of addition to GDP. But of course, the fact that you increase production of military equipment doesn't mean that you increase quality of life. And if you look at quality of life, then the results were quite catastrophic. If you look at, for example, consumption of Russian households, the retail trade, turnover and comparable prices, it did go down by 8 or 10% in 2022. So it's just using the right metrics is also important.
All right, Sergei, thank you very much for the moment. I also note, by the way, that Sergei said it's a tough year to be an economic forecaster. I always think it's a tough year to be an economic forecaster. I prefer looking back. It's always a lot easier. Let's go to another region, Southern and Eastern Mediterranean. Heike, your region. What are you seeing there?
I think it's also an interesting showcase of that this is really a globally interconnected world, and the shocks are really global. So what you see, I mean, first after the COVID, there was actually a good recovery that we saw across the Southern and Eastern Mediterranean region. We saw countries picking up quicker than maybe we had expected. But then we saw the indirect effect of the war on Ukraine more directly actually in the Southern and Eastern Mediterranean region, because vulnerability to energy and food prices were just so much more pronounced. So Egypt is one of the global biggest importers of grain from Russia and Ukraine. Tunisia, a small country, so the global volumes are not shaking the grain price, but they are also depending on grain from that region. So we saw a huge impact on higher grain prices. We saw a huge impact on energy prices. Most of these countries are energy importers, so just the global effect on prices in the energy sector have really shown and subdued growth for that region. And if you look at the comparison, it still looks good. You think, you know, in comparison to global growth, this looks not too shabby. And with the exception of Lebanon, where we have a true recession based also on a lot of domestic issues. But you have to remember, this is the youngest region maybe in the EBRD family. This is a region with high population growth. Egypt alone adds 2 million new people to the labor market every year. So the growth numbers we're seeing for this region are too low to actually generate jobs for the young and for this very young population in these countries, jobs in the private sector. So there is really a laggard effect from the impact of the initial high prices of food and energy, and the decline in food prices have not fed through to this region. So inflation, which we're going to talk about in a minute, is really rising in this part of the world, and basic commodities as well.
Yeah, I think that's, we'll come to the pain that is not going away very shortly, because that's definitely one of the stories, isn't it, of the year ahead. And let's talk about inflation. You know, it's amazing, I guess, how enduring it's been. It's amazing the spike in some countries. Beata?
So we are past the peak of inflation, hopefully. We saw the prices of energy going down. So of course we are not out of the woods yet, because the markets expect uptick in the prices of natural gas later this year. So the inflation has gone down. Now, if you look at the yellow line on this chart, this is what the IMF projects the disinflation path for the EBRD regions is going to look like. If you compare it to the previous episodes of disinflation, also depicted on this slide, you see that this forecast is very optimistic. It is suggesting a very fast disinflation. And actually, you know, that may not become a reality, because a lot of the downtick in inflation was driven by food and energy, but prices of other goods have come down, but prices of services are still going up.
That's a good point, isn't it? You know, when we look at core inflation, you know, that's telling us some quite interesting things about this question of how quickly overall inflation may decline.
Indeed, and core inflation has been stubborn, has been actually very stubborn, going down very little. Core inflation meaning inflation stripped of energy and food prices. Now, of course, this is not something that is limited to our regions. It is a global phenomenon. What makes this region different is the memory of hyperinflation, particularly hyperinflation in the early transition phases. So people may be quicker to raise their inflationary expectations. These expectations may be more entrenched. And of course, we have younger central banks which are less experienced in communicating their intentions to the public.
We'll have a look at the regions in a minute, but when you look at what we have been looking at in terms of that IMF expectation, so as you say, it's likely to be not quite as quick as that. What do you think? Where will we be in 12 months' time then? Where would you see our end point in 12 months' time in terms of what people can expect?
Well, the expectations of the IMF are that we will be at the pre-COVID level of inflation by 2025, right? But that's optimistic. And also in some regions, Central Asia, for instance, Caucasus, will see wages, real wages still increasing. So even though inflation in Caucasus is low, you may still have some of this wage price spiral. So I think I am not particularly optimistic here. I think inflation may stay with us longer than what we can hope for. And of course, a lot will depend on what central banks will do, whether they will find themselves under political pressure, particularly in countries that are facing elections, or whether they will continue at least not lowering interest rates.
So that stickiness of inflation is with us for a while, probably. Let's have a look at the regions. Sergei, Guriev, if I can turn to you again, where do you see regional inflation and the prospects for that in the Caucasus and Central Asia?
Well, in Caucasus and Central Asia, you have an additional component, which is, as I mentioned, migration from Russia. There are Russians with skills and money who run away from Putin's regime. They buy real estate in those countries, they buy goods and services, and we see the upward pressure in countries where they arrive. And it's good for economic growth, as I mentioned, but it's also an upward pressure on the prices, and this is a factor which is unexpected. Nobody thought that such a great inflow would take place, and this is something that you, Jonathan, and the colleagues of EBRD living in London have probably seen before, when rich foreigners arrived in London and real estate prices hiked, pricing out the young Londoners out of the real estate market. So we already see pushback from authorities regarding this. But this is pretty much the fact we can observe. But overall, I share Beata's concerns that inflation is sticky, and this is not just the war, this is not just the grain and oil prices which have contributed. Inflation started well before the war, driven by demand factors globally, like US fiscal stimulus, which probably was excessive, like supply chain disruptions due to COVID and China's zero COVID policy, but also mistakes in monetary policy in countries like Turkey. All of that is, of course, very important. On the other hand, if you compare central bankers today to 1990s, they're young. They don't remember 1990s or 1980s, but they also have tools.
Yes.
I think compared to 1990s, central bankers are much more competent around the regions. And when I mention monetary policy in Turkey, I would also say that central bankers there know what to do. It's just the political authorities deny them independence to do that.
Yes, we'll come to that in just a second. Just very quickly then, Sergei, if I read between the lines of what you're saying, you also think the IMF forecast could be a little bit optimistic.
That's a great question, yeah, and there are many things which are first unknown now, and second, a lot of data are now not transparent, and they shift too quickly. And yes, I rather agree with Beata that maybe forecast that inflation is coming down very soon is too optimistic.
Okay, thank you, Sergei, and thank you for bringing up the known unknowns and the unknown unknowns. We're clearly in that world. Heike, let's turn to you. Egypt, Turkey, two of the big countries, you know, close in your region and close to your region. Some pretty worrying trends there.
I mean, I think it's also interesting. I don't think we can say of the IMF as sort of an optimistic bunch, but I also would want to, in general, but I would generally agree here that...
Sorry, by the way, to any IMF people watching. We love you, really.
But I would also agree that on some of the inflation numbers in particular, the forecast of disinflation might be too optimistic in the sense that there are a lot of underlying factors that are sort of not feeding into the macro data with some delays. So, for example, Egypt, we see a lot of the private sector's wage increases have happened with some delay in different packages that they give their wages in sort of additional wage hikes that are unexpected. So I think there's a lot of uncertainties around the wage price dynamic that Beata was saying that is also true for Egypt. Then there was a lot of pressure. I mean, we're just coming out of the month of Ramadan. For those of you who've not experienced it, it's actually a lot also about family and food. So food prices are really critical to keep them at an affordable level during that month. So governments were under a lot of pressure to keep bread prices low, to keep food prices low. So we also will see some delay of some of these inflationary pressures. And then you see a very mix of foreign currency regimes in the region. So some are pegged to the dollar, so they have seen a really stringent increase in interest rates, and others have more flexibility where interest rates haven't been passed through yet, but I think will need to pass through to control inflation further. So I think there are a number of factors in Egypt also that I would say make at least the short term very interesting, and maybe in the medium term I do see still of the positive fundamentals coming through, but the short term inflation, currency reserves will remain a challenge also for the central bank to manage. And I want to come back also to a point that Beata mentioned. Communication about monetary policy is not the same, at least sort of if I talk about the southern and eastern Mediterranean region, than what we are used to maybe from European central banks. So there is always an opaqueness around the communication, which makes it more difficult to businesses also to anchor inflation expectations. So I think a few interesting months with lots of volatility around the exchange rate, and also inflation expectations to come, in particular in big economies like Egypt.
Well, and of course, if we look at Turkey now after the first round of the elections, we don't know whether normal monetary policy is going to resume, or whether we're going to have a continuation of the unusual monetary policy, if I can put it that way, that has been pursued by the government there. So that must make inflation forecasting almost impossible, actually, for the next few months at the moment. Yeah.
Absolutely, and I think we haven't really spoken the impact of inflation forecasts also for the business community and what they perceive as inflationary pressure and foreign exchange pressure in making their investment decisions. So we also see some delayed investments on the back of the uncertainty created around foreign currency and inflationary predictions. And so we do see also a suppression of investment decision, and hence which will feed through lagged growth.
Okay. Let's turn now, Beata, to the question of recessions. You know, it's quite extraordinary, isn't it, if you think about what we lived through in the past 2 or 3 years in terms of economic black swan events, you know, which have come along quite quickly. We've had the COVID recession, we've had the impact now, the economic impact of the war, and its ripples across all economies. So how do you see that?
Well, so economies in our regions have experienced 2 technical recessions in close succession, the pandemic-induced recession and the current slowdown. Now, of course, I have to come back to the issue of how challenging it is to make forecasts in turbulent times. And that's for 2 reasons. First, we actually don't have a very good picture of what happened in the past, simply because the initial estimates of GDP tend to be revised later, and they tend to be revised more during times when there's a lot of uncertainty. And second, it's incredibly difficult to make assumptions about the future. I mean, take the war. It's very hard to know how things will develop. In one of our previous reports, we looked at how good Eurostat forecasts were during the global financial crisis. And in particular, we looked at the last quarter of 2008, so basically the first quarter of the crisis. And what you saw was that the forecast, as well as the initial GDP estimates, were wildly off. And there wasn't a positive bias or a negative bias in one or the other. There wasn't they were wrong even in different directions for the same country. So you need to take this graph with a pinch of salt.
I think often with all economic forecasts, you need to take with a pinch of salt. They are forecasts. I think people often forget that they are forecasts and not actuality. Let's dig into this a little bit more. Sergei, Guriev, if I could turn to you. What do you see as the threats to growth in the near future, in particular in Central Asia and the Caucasus?
Well, EBRD is now much more optimistic about Central Asia and the Caucasus than just a year ago. And part of that is that we saw the resilience of those economies in 2022, and also the way they actually benefited from trade diversion in 2022 when Russia moved its trade through directly trading with Europe, which was Russia's biggest trade partner, through to trading with Europe through third countries, including Central Asia, Caucasus, and Turkey. And the EBRD in its own work has shown how important those shifts were. And so that was a great contributor to economic growth of those countries. Now, Europe, the Great Western Coalition, pro-Ukrainian coalition, is now trying to shut down those loopholes which help Russia to circumvent sanctions. And so that is a main threat to growth in countries which have benefited from this trade diversion. And so Europe is quite serious about this. Last year, as you know, they've created a special envoy for sanctions. Now this office is led by David O'Sullivan. The 11th package of sanctions will target some of those loopholes. There are secondary sanctions that Europe has announced already, and they've created this tool to punish countries that help Russia to circumvent sanctions. So this is a very, very important threat to economic growth to Russia's neighbors, in particular Turkey, Caucasus, and Central Asia.
And in terms of Russia itself, Sergei, if I can interrupt you then, presumably this is the year as well where you see the possibility of sanctions really starting to have some impact on Russia.
That's correct. As I mentioned, the real sanctions against Russian stock of petrodollars were introduced on the day 3 of the war, but the flow of petrodollars continued last year, and it is this year when Russia is facing major problems with earning oil revenues, and the gas sales to Europe have pretty much stopped. The European buyers of Russian gas have pretty much stopped buying Russian gas for whatever reason, including the mysterious explosions in Nord Stream 1 and 2. Overall, what we see is a major impact on Russian budget. Russian government authorities are now facing the need to introduce austerity, and that's not going to be easy, neither for Russian government nor for the Russian economy. Russian oil and gas revenues in the first quarter of 2023 are about half of what they were in the first quarter of 2022. It's a huge, huge difference. And so Russia will have to do something with financing this deficit. Now, IMF is always optimistic, as we mentioned already, but the optimism IMF is based on the idea that Russian banks are actually sitting on a pile of liquidity. But this is a known unknown, if you like, Jonathan. We are not young, so we remember
yes.
American policymakers used this concept. So Donald Rumsfeld it was who said that we need to distinguish known unknowns from unknown unknowns. And basically this is a known unknown. Russian banks don't publish data, and so you have to make assumptions how healthy they are and whether they will be able to lend to Russian government to help to overcome this major fiscal challenge. And so that is something we don't know. And so Russian economy may do less well than IMF thinks. And here I'm again closer to EBRD's forecast, which is more negative than IMF.
Thank you, Sergei. I think the most surprising thing we've heard today is that the sun always shines at IMF headquarters in Washington, which is clearly what we're feeling. What I think one of the most interesting things of the past year, and not just in EBRD economies, but in many economies, was how well, considering the pressures that were bearing down on economies, that they held up, because people still had a bit of COVID saving left in many economies. But I don't know, Beata, how you see that. You know, what does that tell us now about the state of personal finance? Because you get the feeling that's sort of dripping away.
Indeed, things are not looking as good as they looked before. You know, if you turn on TV in London or in Berlin, you hear on the news discussions about cost of living crisis. But actually, it's the emerging countries that are feeling the cost of living crisis much more. And I think that's very much underappreciated in advanced economies. I think it's fair to say that households are just getting by. You know, in Eastern Europe, Caucasus or Southern Eastern Mediterranean, 80% of households are just making ends meet, or they have to dip into savings to survive. Moreover, this is true in Central Asia for about half of the households. Also, if you ask people, and these are the data that come from our latest household surveys, we surveyed so far 14 countries, late last year, early this year, more than 1,000 households in each country. What you also see is that there is great vulnerability. Majority of households, if they lost their main source of income, they would be able to cover their basic expenses for no more than a month. And this contrasts very sharply with the resilience of, for instance, German households. So, you know, this succession of two crises has left households very vulnerable to shocks.
It's quite a bleak picture in some ways, isn't it? And shows a lack of resilience, bearing in mind that the whole theme of our meeting here these few days is about resilience. So where do you see any signs of hope, Beata? You know, where's the economic cavalry riding in from, if from anywhere?
Well, so one sign of hope is the process of reshaping of global value chains. I think the war triggered a realization that geopolitical shocks are not going away. And firms which so far have been reluctant to diversify their supplier base are doing that. Right? And we saw this in surveys of German firms, where 2/3 of German manufacturing firms have added new suppliers. Half of them are intending to do so in the next 12 months. And this is an opportunity for the broadly defined European neighborhood. Right? So German firms will not be dropping Chinese suppliers, but they want the model China plus one. Mm-hmm. And now the question is, who will become the plus one? And I think, you know, there are many countries within our regions that could become that plus one.
That's an interesting thought. And Heike, so is there a plus one opportunity in your region?
Absolutely. So here comes maybe my eternal optimism. But no, we do see really with, in particular, labor costs low and with declining exchange rate in big markets like Egypt, that Egypt has become increasingly competitive also as a manufacturing hub. And I think maybe here I want to start talking a little bit about the energy transition that we see globally, which I also see could be an opportunity and could actually be also fast-tracked now. I think the diversion away from Russian gas has also led, in particular countries where the sun always shines and the wind blows quite hard, to invest in renewable energy. And I think this is actually shown that not only will that help to green the energy systems in these countries, but also we see more and more big connectivity projects. We see connectivity projects in sea cables, ELMED from Tunisia to Italy, from Egypt to Greece. So there will be more green energy being produced in the north of Africa, for example, and sold to Europe. So this in itself is a big opportunity for these markets. But the biggest price on this is how much of the value chain can you actually keep in these markets. So how much of, the wind blades can be produced in Morocco or Egypt, and how much of parts of these constructions can be produced in these markets. And there I have to say, maybe at least in these, for example, wind blade value chain, Egypt is really positioning themselves. They want to be the +1. They want to be the company that produces wind blades, because they will also have huge wind parks where these wind blades don't have to travel miles and miles. So I think around the green energy transition, that's the biggest opportunity, but also other manufacturing areas around transportation will become more competitive with a bit of more diversification of global value chain. I was just telling Beata this morning, we see even in a small scale industries such as lighting that is helping electrification in a number of areas, that the supply disruptions from China have even told some Egyptian and Tunisian manufacturers to diversify, to produce more components locally, to benefit both from the favorable economic condition, but also be more diversified against global shocks. So I think we do see a lot of opportunities around relocating some of the industrial base to countries with now lower labor force costs, but actually good connectivity through the Mediterranean and, for example, the Red Sea in the case of Egypt.
That's a very interesting point, Heike, and maybe, Sergei, I could just follow on with a question to you, because if you think about Central Asia, where there are big plans for renewable energy, you're here in Uzbekistan, I think the plan is for 25% of all energy to be renewable by the end of this decade. I think renewables go from something like 2 megawatts to 8 megawatts, a big, big increase. What does that mean, do you think, for economic growth opportunities, Sergei?
Well, this is the most important growth opportunity for the future. The world is now accelerating the green economic transition. If anything, this work has demonstrated is the danger of relying on fossil fuels exported from non-democratic countries. And in that sense, this is the opportunity, and this will be in demand by all partners around the world. And as Heike mentioned, this is definitely true for all European neighborhood, but it's also true for countries in Central Asia. So this is the right way to go, and we are behind on Paris Agreement's objectives, and so whoever can contribute to global green economic transition should benefit from that.
All right, by the way, if you're in the audience here or indeed online, your chance to answer a question in just a minute, so think about your questions. Maybe just a final round, actually, with the three of our panelists. We've talked about the massive uncertainty, the difficulty of really looking ahead over the next 12 months. Do you have best case and worst case scenarios in your mind of how bad or indeed how good it could get? I mean, Beata, what do you think?
So I am worried about US discussions about raising the debt ceiling, right? So our regions had been able to borrow in international markets very cheaply, pretty much until the time the war started. And once the war started, the cost of financing went up, both in absolute terms as well as relative to the cost of financing faced by Germany or the US. Now, if the US lawmakers do not reach a deal on raising the debt ceiling, or if this deal comes so late so that the US debt is downgraded, right? And in 2011, Standard & Poor's downgraded the US debt, right? Yeah. That it never came up. That is going to send jitters through the global economy, and that's going to raise the cost of financing in absolute terms, and most likely it's going to induce investors to demand greater compensation for macroeconomic risks.
That's really interesting, isn't it? Because I think increasingly we see we are often a hostage globally on the economy to something happening in one country, far more than perhaps we have been for a very long time. I don't know, Heike, how do you see it?
No, absolutely. So for me also, in line with what the scenario Beata described, I think the ever-increasing flight to safety in uncertain terms, this is bad news for emerging markets, because this will reevaluate their macro risk, but also their investment risk. So my downside scenario is also triggered not by something that's happening in the emerging markets, but actually what's happening outside of them, which will make their resilience to another shock even more challenging, and their ability to attract foreign investments that they need to grow even more difficult. And so my worry is indeed that this flight to safety will lead to less interest by investors into emerging markets, and so the opportunities that we just described will be not picked up with the same amount of rigor and enthusiasm. And so we will see another shock wave coming to them, which their policy instruments also don't have real, bite to tackle.
Sergei, Guriev, I could see you nodding your head throughout some of that.
Yes, I fully agree with what Beata and Heike have said. And for me, it's very hard to be optimistic about what's happening in Ukraine and Russia and the neighborhood. But things may be even much worse, much worse, if we have geopolitical problems between China and the U.S. And I think the optimistic scenario is some kind of understanding that can emerge between China and the U.S. that will be clearly defining where these countries cooperate and where they are rivals. And when we talk about friendshoring, fragmentation, and so on, I think a lot of jitters that Heike and Beata were talking about are coming from the uncertainty that we don't know what the US is going to do if China does this, and what China is going to do if US does that. And I think the optimistic scenario is appeasement, or at least some clarity on how the new Cold War is going to take place, because indeed for our region, Western Europe, Central Europe, Eastern Europe, CEMET, Central Asia, Caucasus, these are the regions which are caught up in this Cold War. And once US and China agree to disagree on certain things and agree to cooperate on other things, the world will be much clearer, and it will be much safer, both in geopolitical and economic terms. So that's my optimistic scenario, that the Cold War between US and China, which is going to happen, will be well managed.
Okay, Beata, I think you want to come back.
Just to follow up on what Sergei said, in our latest transition report, we asked the what-if question. What if the world were to break into two trading blocks and the trading cost between them went up by 20%? And the answer was everybody pretty much would lose. The countries among our regions of operation that would lose the most were Kazakhstan, Morocco, and Bulgaria. And that's because they have trading links to two regions. And there are emerging markets that think, well, should there be this fragmentation process, they are going to benefit because they will capture some market away from China. But I think that is a false narrative, because in such a world, the global trading rules would become ineffective, and there would be nothing to constrain countries from increasing tariffs, from constraining their exports, from engaging in a subsidy race.
Yeah, it'd be incredibly disruptive, wouldn't it? I mean, that's...
Can I quickly follow up on this, John?
Yes, of course.
I think
Yes,
the
Sergei.
optimistic scenario is... the optimistic scenario is that this fragmentation is limited to a very narrow set of goods and services which are strategic, and protectionist forces don't abuse this definition of strategic sensitive goods to protect their own markets, which are non-strategic. That's my optimistic scenario, because eventually US and China will have to cooperate, for example, on green economic transition, and I hope that will help everybody. So I hope that it will not be this what-if scenario, 20% increase on all goods and services, because that will definitely be very costly for everybody. But it's already the case from where I'm sitting in Paris. It's already the case that even between US and Western Europe, the issues of cooperation on green transition is not easy. And Inflation Reduction Act has created a lot of concerns, let's put it this way, on this side of the Atlantic, already between very close allies.
Yes, and there are also questions about what it's done to the American economy, actually, I think, in some way. Sergei, thank you very much for the moment. Right, questions here in the audience. If you've got one, put up your hand. I see some hands going up already. If you're watching online, just go to slido.com and enter the code 1279662 if you want to send a question, or, of course, you can send your questions in the comments on LinkedIn and our other outlets as well. So let's take some questions. I saw some hands going up over here. We have a microphone, hopefully we can get you, is that right? Yes, okay, so we go over there first of all.
Thank you. Hello, my name is Sergei. I have a question for Sergei Guriev. Dobry wieczór. So, by the way, I'm your follower in YouTube channel, so you can send me your latest book free of charge.
No free advertising here, Sergei, right?
Thank you. So, what's going on the landscape of the political change of Central Asia? Do we have any chances to rebalance of our trade relationship? Because for many years ahead maybe, our main trade partners is Russia and China. Maybe somehow going on in Turkish, and Kılıçdaroğlu is maybe pro-European leader. I don't know who will become next. Is that any chance for Central Asia countries to rebalance trade partners moving to Europe or other developed countries? Thank you.
Sergei.
Don't forget about book. Thank you.
Okay, Sergei.
Thank you very much. We have an agreement with my publisher, Princeton University Press. I write books, they sell books. So you should ask them to donate this book to you. But I'm happy to announce that the new paperback edition is out, and also Russian translation is done. So it will soon be available both within Russia and outside of Russia. So on the trade issue, I would actually want to hear what Beata has to say, because indeed the transition report has done a lot of work on this issue. What I'm going to say is, in trade we know that trade is very distance dependent. The gravity laws are very important in trade, so you trade with your neighbors mostly, and we see people who work for EBRD in London have seen how Brexit has been difficult, because Brexit has aggravated the relationship with the neighbor, Europe, for the United Kingdom. But of course this war has sent shockwaves throughout every part of the world, in particular Central Asia, and there will be more trade between Central Asia and other countries as long as this particular political regime is in the Kremlin. But overall, regarding Turkey, Turkey was open to trade with Erdogan, and whatever political change happens in Turkey or doesn't happen in Turkey, Turkey will be open to trade with Central Asian countries. And the same is true in with China. But Russia is a difficult question. But what I said before is important. Some of this trade, which grew last year, was help to Russia to circumvent sanctions. And Europe will work a lot on stopping this trade. So some of this trade diversion, which was Russia-Europe trade, which is now Russia, Central Asia, Europe trade, will probably be limited due to sanction action by European Union and other Western players. But overall, in the long run, of course, Europe is a big market. And of course, as we mentioned, in terms of renewable energy in particular, there is a great demand by the whole world, including Europe, to work on this.
Beata.
So I will abstract from the geopolitical issues and rephrase your question as, how do you geographically diversify exports from this region? How do you diversify the economies? How do you introduce new products? International experience shows that countries that successfully started exporting new products, so-called export discoveries, in most cases did so because FDI came in. So it was the multinationals that located production in a particular country, because the multinational had the knowledge of how to produce this product somewhere else. They brought it to a new location, and they had the distribution network. So in other words, an answer to your question is FDI promotion strategy, being open to FDI, and in particular trying to attract FDI in sectors that you want to develop. Though of course you need to have a realistic chance of developing these sectors, right? It can't be sort of a crazy idea. is probably the best bet.
Okay, thank you very much. There was a question here in the front row. Do we have a microphone we can bring to the front row just here? Thank you very much.
Thanks for the great panel. Georgia Arveladze from Georgia. Just to follow up on Beata's concern on the US debt ceiling. The interest rates, like 6-7 years ago, the very common idea was that the low interest rate environment was the new reality and there was no reason it would go up anymore. Now we are where we are. We've seen both the zero interest rate decade and the high interest rate decade right before that. So what's your view, the next decade? Is it going to be the 5% interest rate decade, or this is something very short term? Especially that inflation seems to be inflating away the sovereign debt seems to be one of the only viable prospects. Thanks.
So my personal view is that the last decades of very low interest rate were more of an anomaly rather than a new normal. Right? Take globalization. Over the last few decades, globalization was keeping a lid on inflation as China joined the global economy and the world was able to import very cheaply manufactured goods. Now, globalization is actually a source of inflationary pressures. So one of the big sources of low inflationary pressures is gone. Also, there was a global savings glut. I think as times have become tougher, there will be fewer savings to go around. So I subscribe to the view that we are not going to see the low interest rates that we saw before.
Thank you very much. One question we've had on LinkedIn. Is the EBRD projection for 2024 optimistic regarding food prices and the standard of living of citizens generally? Is there a chance prices are going back to where they were before the pandemic and the war in Ukraine? Beata, I'll ask you first, and then perhaps maybe you, Heike. This is a big issue, of course, in your region. Beata.
So, we are trying to be optimistic. So what we saw was a huge spike in food prices, but since October, food prices, particularly grain prices, have been going down. We were concerned that it wouldn't be possible to take grain out of Ukraine. We managed to do so, not perfectly, and you may remember discussions in recent weeks in Eastern Europe about very big shipments of grain coming from Ukraine by land. That's something that wasn't possible before. Also, in the US, there were concerns about drought. They went away. The area on which wheat has been sown is 9% higher than in the past. So I am less worried about food prices. I am more worried about energy prices in Europe, prices of natural gas, because that's what futures markets are telling us.
Which can also feed into food prices, of course, depending on the production. Yeah.
Of course, but of course, a lot will depend on how the war plays out, and here, we don't have a crystal ball, so it's difficult to tell whether our forecasts are optimistic or pessimistic.
Heike, get your crystal ball out and tell us in your region.
No crystal ball for my region either, but what we have seen indeed is that the pressure of global food price hikes have also led to more diversification strategies. So I think deeply dependent countries like Egypt, with 80% of grain imports from Russia and Ukraine, and Tunisia, have also started to increase local production, have increased efficiency of local production, and have started to diversify. And so that is also, of course, giving hope that there is a sort of a moderation of global food price pass-through to these countries. But then again, I think on drought, unfortunately, not so good news. So, for example, Morocco has one of the driest periods in over 40 years. And actually, we had praised Morocco of a diversified grain importation strategy and very good local production. But now with this unprecedented droughts that you see also in a number of the North African countries, that has also put another sort of pressure on, in particular, water-intensive crop production. So I think what I think has also happened, which we haven't spoken of, is also regional cooperation. So for the first time, also some of the Middle Eastern countries are speaking of joint storage opportunities and also better cooperation in crises around food and grain in particular. So I mean, this is of course another policy option that would potentially help to dampen some of these shocks and sort of these idiosyncratic weather shocks, drought in Morocco, but actually a decent harvest maybe somewhere else in the Middle East to hopefully have a better joint solution to these problems. But I think we don't see the same spikes due to the global effect, but I think there's a lot of local volatility around food in these markets.
And Sergei, Guriev, just very quickly, I mean, generally, do you see our standards of living going back to where they were before we had these twin recent crises?
Well, eventually, global economy and especially emerging markets are going to grow. And there are many growth opportunities, and I'm very proud to have worked at EBRD, have contributed to the development of our countries, and I would like to thank you very much for inviting me today to this debate, because I think EBRD is playing a very important role in helping emerging markets to grow. And I think economic growth, especially if political models are correct, economic growth will lift all the boats. I'm also very grateful to Beata continuing the work on the Life of Transition Service, which shows which household actually benefit from growth and which suffer from political and economic difficulties, which helps to change the policy to make sure that households benefit from economic growth. But overall, in the long run, I'm of course optimistic. In the short run, as I mentioned, we cannot neglect the geopolitical disasters which are happening in several countries in our region, in particular the Russian aggression in Ukraine.
Sergei, thank you very much. Thank you also to Heike and Beata. Thank you to all of you, by the way, for being with us, both here in the room and indeed online. Our latest economic forecasts are available online on our website, ebrd.com. If you enjoyed this conversation, you can subscribe to our podcast, of course, where we discuss this and more things. You can download it on iTunes, and we love it when you review and rate the podcasts. That really helps us to understand as well what you want to hear about. But thank you all very much. Goodbye.
Thank you.